Whether you're a seasoned real estate investor or a first-time homebuyer, Victory Home Loans knows what it's like to apply for a mortgage, and we strive to never forget that feeling. We are a highly knowledgeable group of mortgage professionals who pride ourselves on top-notch communication. We are dedicated to educating you on the mortgage process. Please enjoy this video. Underwriting is a crucial component of the mortgage process that dictates whether or not you'll get the final loan approval. In this video, we're going to share what happens when your home loan is underwritten. Let's dive in and learn more about underwriting and how it works. Underwriting is the process by which your lender verifies your income, assets, debt, and property details in order to issue final approval on your loan application. Underwriting happens behind the scenes. Your lender might ask for additional documents and answers, such as where bank deposits came from, or ask you to provide proof of additional assets. So what does an underwriter do? A mortgage underwriter takes a look at your finances and assesses how much of a risk a lender will take on it if they decide to give you a loan. The underwriter helps the mortgage lender decide whether or not you'll get approval on your loan. The underwriter will ensure that you don't close on a mortgage that you can't afford. If you don't qualify, the mortgage underwriter can deny your loan. So how long does underwriting take? Your mortgage can be just as unique as your financial situation, so the exact amount of time underwriting takes will vary on a case-by-case basis. The sooner you get all of the necessary documentation to your loan originator, the sooner your loan can be underwritten. So it's important to get all requested documentation to the lender in a timely manner. What makes up the mortgage underwriting process? The underwriter evaluates your finances and past credit decisions. During the underwriting process, your underwriter looks at 4 key areas that give them a more complete picture of you. The first is income. Your underwriter needs to know that you have enough income to cover your mortgage payments each and every month. To prove this, you will need to provide 3 types of documents to verify your income: your W-2s from the last 2 years, your 2 most recent bank statements, and your 2 most recent pay stubs. Are you self-employed, or do you own a sizable share in a business? If you do, you'll need to furnish a few different documents in lieu of your W-2s. These include your profit and loss sheets, K-1s, balance sheets, and your personal and business tax returns. Your underwriter will also check that your income matches the income you report and verify your employment situation with your employer. Next, they'll look at your appraisal. Appraisals are almost always required when you purchase a home. They provide protection for both you and your lender because they ensure you only borrow what the home is actually worth. An appraiser will inspect the property and walk through the home to take pictures and measurements in order to evaluate the condition and features of the home. The appraiser compares similar properties by looking for homes that are similar in location, size, and features. These comps, as they're called, need to have sold within the past 6 months and be within a mile of the property unless you live in a rural area. Your underwriter will also look at your credit. Your credit score shows the underwriter how responsible you are when you pay back debt. A good credit score shows that you pay back your debts on time and can also help you qualify for a lower interest rate. The minimum credit score you'll need to have depends on what type of loan you are applying for. The underwriter looks at your income, what you owe, and what you want to borrow to determine your debt-to-income ratio, or DTI. Your DTI is the total amount of money you spend on bills and expenses each month, divided by your monthly gross, which is your pre-tax income. Lenders prefer to see a DTI ratio at or below 50%. Next, the underwriter will look at your assets, and it can help you get a mortgage approval because they can be sold for cash if you default on your payments. An underwriter might view your checking and savings accounts, real estates, stocks, and personal property. The bottom line is, underwriting simply means that your lender verifies your income, assets, debt, and property details in order to issue final approval for your loan. An underwriter is a financial expert who takes a look at your finances and assesses how much risk a lender will take on if they decide to give you a loan. Throughout the underwriting process, it's a good idea to actively respond to your lender's requests. Don't apply for any new credit lines during underwriting and respond to inquiries as quickly as possible. Also, be upfront and honest about your finances, or this will cause delays in the loan application process. And of course, remember, your loan originator is here to help you along the way. Thanks for watching. We are here to answer your questions and help you through the process. We're excited for the opportunity to earn your trust by offering the right mortgage for your unique financial scenario. You can reach us online at www.victoryhomeloans.net. We look forward to working with you.